Welcome back to Currency Now, where we break down the biggest financial moves shaping the global economy. Today we're diving deep into the Dow Jones's worst day of 2025, a brutal 649-point drop in a single session. This wasn't just a red day, folks. We're talking about a sea of red, a bloodbath, the kind of day that makes even the most seasoned traders sweat. This wasn't just a bad day on Wall Street, this was a wake-up call for investors, traders, and policymakers worldwide. We're talking about a seismic shift, a real paradigm change. It's the kind of day that makes you question everything you thought you knew about the market. Was it tariffs, inflation, panic selling? Stay with me as we dissect why this crash happened, who got hit the hardest, and what this means for you moving forward. We're going to break it down step by step so you can understand the forces at play and protect your hard-earned money. This is about survival, people. Make sure to smash that like button and subscribe if you want real-time insights on global markets. Now, let's get straight into it. March 4th, 2025, a day traders won't forget. Picture this, you're sitting at your trading desk, coffee's cold, eyes glued to the ticker, and bam! The Dow Jones plummets 649 points, wiping out weeks of gains. It's like watching a runaway train. You know it's going to be bad, but you can't look away. The S&P 500 and Nasdaq weren't spared either, both tanking nearly 2%. It was a broad sell-off, folks, a sign that investors were heading for the exits. We're talking about trillions of dollars of value evaporating into thin air. This wasn't just a blip on the radar. This was a full-blown market earthquake. So what triggered this market meltdown? What could possibly cause such a dramatic shift in sentiment? Was it a black swan event? A natural disaster? Nope. The immediate culprit was far more predictable, a shockwave of new tariffs from Washington. President Trump, in a move that surprised absolutely no one, announced a 25% tariff on imports from Canada and Mexico and a 20% duty on Chinese goods. The market's reaction, pure panic. It was like someone had yelled fire in a crowded theater. Everyone was running for the exits, desperate to unload their positions before things got even worse. Then came the domino effect. China hit back with their own countermeasures, banning U.S. agricultural imports and biotech exports. Canada and Mexico retaliated with their own tariffs, leaving investors wondering, is this the start of another full-blown trade war? Now, tariffs themselves aren't necessarily a bad thing. They can be a useful tool for protecting domestic industries and negotiating fairer trade deals, but when you start throwing them around like confetti at a parade, you're playing with fire, and that's exactly what happened here. The Trump administration, in its infinite wisdom, decided to play hardball with some of our biggest trading partners. They thought they could bully their way into a better deal, but guess what? It backfired spectacularly. The Chinese, Canadians, and Mexicans aren't exactly known for backing down from a fight. This tit-for-tat tariff war created a massive cloud of uncertainty over the global economy. Businesses hate uncertainty. It makes it impossible to plan, to invest, to grow. And when businesses get spooked, they pull back. They lay off workers, they cut investments, and they hoard cash. That's not exactly a recipe for economic growth. In fact, it's the exact opposite. And that's what really spooked the markets. When the news of the tariffs hit the wires, it was like someone had flipped a switch. The mood on Wall Street went from cautiously optimistic to downright apocalyptic in a matter of minutes. Traders were glued to their screens, frantically trying to make sense of the chaos. Phone lines were melting down as investors called their brokers, desperate to unload their positions before it was too late. It was a classic case of panic selling, and it was feeding on itself. The more the market fell, the more people wanted to sell, which only drove prices down further. This wasn't just a rational response to changing economic conditions. This was fear and greed at their most primal. It was a stampede of epic proportions, and everyone was trying to get out of the way of the falling knives. The question on everyone's mind was, how far would it fall? And more importantly, when would it end? Now, let's be clear. The Dow's drop wasn't an isolated incident. It wasn't just a few big companies having a bad day. This was a systemic shock that reverberated across the entire market. We're talking about a ripple effect that touched every corner of the financial world, from the highest high flyer to the most mundane bond. The S&P 500, a broader measure of the US stock market, had its worst day in months, down 1.8%. The Nasdaq, home to many of the high-flying tech giants, cratered 2.6%, hitting its lowest level since November. And the small-cap stocks, those scrappy up-and-comers? The Russell 2000 fell 2.8%, a massive blow to growth stocks. It was like a Category 5 hurricane ripping through the market, leaving a trail of destruction in its wake. And here's what's really telling: even strong blue-chip stocks weren't spared. These are the companies that are supposed to be the bedrock of the market, the ones that are too big to fail, but even they weren't immune to the carnage. Companies with high international exposure, Apple, Boeing, Tesla, saw their stocks plummet. Why? Because investors saw one thing loud and clear: higher tariffs mean higher costs. Higher costs mean lower profits. And lower profits, they mean sell-offs. It's basic math, folks. Now, when uncertainty strikes, smart investors look for safety. They want to park their money in assets that are going to hold their value or even appreciate in times of turmoil. They want to avoid the bloodbath, the carnage, the utter destruction that's happening in the broader market. And guess what? They found it in the classic safe havens, gold and bonds. Gold prices skyrocketed as investors scrambled for a safe haven. It's the age-old story. When the going gets tough, the tough buy gold. It's a tangible asset. It's been a store of value for centuries, and it tends to do well when everything else is going to hell in a handbasket. Bonds, particularly US Treasury bonds, also saw a surge in demand. The US 10-year Treasury yield barely moved, signaling risk-averse money flooding in. Investors were willing to accept lower yields in exchange for safety and security. They were basically saying, I don't care if I make a lot of money, I just don't want to lose what I have. And then there's the CBOE Volatility Index, VIX, Wall Street's fear gauge. It spiked 20% in a single day. This index basically measures how much fear and uncertainty there is in the market. And let me tell you, on March 4th, 2025, there was a whole lot of fear going around. Why the panic? Why were investors so spooked by these tariffs? It's simple. They were afraid of stagflation. Stagflation is a toxic cocktail of stagnant economic growth and high inflation. It's the worst of both worlds. You've got a sluggish economy that's not creating jobs or raising wages, but you've also got rising prices that are eating away at your purchasing power. The tariffs were seen as a double whammy that would both slow down the economy and push up prices. The tariffs would make imported goods more expensive, which would lead to higher prices for consumers. And at the same time, the tariffs would disrupt global supply chains, which would hurt businesses and slow down economic growth. It's a lose-lose situation, and investors knew it. They were staring down the barrel of a stagflationary spiral, and they didn't like what they saw. This wasn't just a blip on the radar. This was a potential paradigm shift in the global economy, and that's why they hit the panic button. Booyah! Did somebody say tariffs? Because that's the sound of the market crashing down around us. When the news of these tariffs hit, investors hit the panic button, and rightfully so. This isn't some small-time trade spat, folks. This is a full-blown trade war brewing, and it's enough to make even the most seasoned investor sweat. Listen, when uncertainty rears its ugly head, smart money runs for cover. And that's exactly what we saw happen. It's like investors saw a hurricane coming and decided to ride it out in a bunker made of gold. And who can blame them? Gold, that beautiful, shiny, safe haven, saw its price skyrocket as investors scrambled for something, anything, to protect their hard-earned capital. But gold wasn't the only game in town. Oh no, folks, the classic safe haven, US Treasury bonds, also saw a surge in demand. The yield on the 10-year Treasury barely budged, which tells you one thing. Investors are parking their money and bracing for impact. They're battening down the hatches, waiting for the storm to pass. And if you need even more proof that fear is running rampant, just look at the VIX, the market's fear gauge. This thing spiked 20% in a single day. That's like watching a horror movie and seeing the monster jump out of the screen. Except this time, the monster is inflation and slowing growth. Let's talk Turkey, folks. The reason everyone's freaking out is because these tariffs have stagflation written all over them. That's right, the dreaded S word that sends shivers down the spines of economists and investors alike. It's a toxic cocktail of stagnant economic growth and runaway inflation, and it's the last thing anyone wants to see. Think about it. Tariffs mean higher prices for businesses, which get passed down to you and me, the consumers. That's inflation 101. But at the same time, these tariffs disrupt global trade, create uncertainty, and put a damper on economic growth. It's a lose-lose situation, and investors are right to be worried. Now, I'm not saying you should run for the hills and hide your money under the mattress, but you need to be smart, folks. This market volatility isn't going away anytime soon. The VIX is telling us to buckle up because we're in for a bumpy ride. So what's an investor to do? Don't panic, that's for sure. Panic selling will only lock in your losses. Instead, take a deep breath and remember the fundamentals. Diversification is your best friend in times like these. Listen up, because I'm only going to say this once. Diversification is your best defense against market turmoil. It's like having an all-star lineup of investments ready to take on any challenge. You need some gold to protect against inflation, bonds for stability, and yes, even some stocks. Because when the market eventually rebounds, you want to be there to ride the wave. And don't forget about cash, folks. Having some dry powder on hand allows you to take advantage of buying opportunities when they arise. Because let me tell you, there will be deals to be had in this market. When fear takes hold, it creates opportunities for those who are prepared. Remember, knowledge is power. Keep your eyes glued to the markets. Stay informed about the latest developments and listen to your favorite financial news commentator. That's me, folks. Most importantly, don't let fear dictate your investment decisions. Stay calm, stay focused, and weather this storm like the savvy investors I know you are. You think this was just an American problem? Think again. This was like a tidal wave of selling that swept across the globe. Europe got slammed. Germany's DAX down 2.1%. The UK's FTSE down 1.7%. These are major economies we're talking about, folks, not some penny stocks. And China? They got hit with a double whammy. First, the trade war reignites, sending the Hang Seng down 2.5%. Then they get hit with the global risk aversion wave. This tells you one thing. Investors worldwide are running scared. They're dumping risky assets faster than you can say margin call. This is a global synchronized sell-off, and that's never a good sign. And if you thought developed markets had it bad, let's talk about emerging markets. These economies are built on growth, and trade wars are like kryptonite to growth. Brazil's Bovespa took a tumble and India's Sensex got slammed. These markets are much more vulnerable to global trade disruptions, and investors know it. When the big money gets scared, they pull out of these markets faster than a cheetah on a hot date. And that selling pressure, it sends these markets into a tailspin. So, what does this tell us? It tells us that this isn't just a US-China story. This is a global story with global implications. Now, let's talk about everyone's favorite sector, tech. Did tech escape the carnage? Not a chance. We saw chip makers like Nvidia, AMD, and even mighty Intel down over 5%. These are the engines of the global economy, and they're sputtering. Why? Because when global trade slows, demand for everything from smartphones to servers drops. And when demand drops, tech stocks take a nosedive. This is a clear warning sign that this trade war could have a serious impact on the global tech industry, and that should worry everyone. All right, let's cut to the chase. What does this market meltdown mean for you? If you're an investor, here's the deal. Buckle up, because we're in for a bumpy ride. That VIX spike, that's the market screaming fear. And fear means volatility. We're talking about wild swings up and down, and that can be an emotional roller coaster. But remember, volatility can be your friend if you're smart. Don't panic sell. Instead, use this opportunity to buy quality companies at a discount. Keep your eyes on the fundamentals and look for companies with strong balance sheets and a history of weathering storms. That's how you turn a market downturn into an opportunity. Now, if you're a business owner, especially if you rely on imports, get ready for some pain. Those tariffs, they mean higher costs for you, and that means lower profits. And it's not just the tariffs. Supply chains are getting disrupted, which means delays and shortages. So what can you do? First, get lean and mean. Cut costs wherever you can. Second, diversify your suppliers. Don't put all your eggs in one basket, especially if that basket is made in China. And finally, communicate with your customers. Be upfront about potential price increases or delays. Transparency builds trust, and trust is crucial in uncertain times. And let's not forget about consumers. You're going to feel the pinch too. Those tariffs, they're going to show up as higher prices on everything from that new smartphone to your groceries. Inflation is a sneaky beast, and it eats away at your purchasing power. So what can you do? Well, you can start by cutting back on unnecessary spending. And if you've been thinking about making a big purchase like a new car or appliance, do it sooner rather than later. Prices are only going up from here. Remember, knowledge is power. The more informed you are, the better equipped you'll be to navigate these choppy economic waters. So, there you have it, the worst day of 2025 for the Dow Jones. 649 points gone, just like that. Markets rattled, investors scrambling. Was this a temporary panic, or are we on the edge of a bigger downturn? That's the million-dollar question everyone's asking, and frankly, I don't have a crystal ball, but here's what I do know. Uncertainty creates opportunity, and right now, there's plenty of uncertainty to go around. So what are you going to do? Are you buying the dip or selling everything? Let me know your thoughts in the comments below, and before you go, hit that like button, subscribe, and turn on notifications. Because trust me, this roller coaster ride isn't over yet. This is Currency Now, and I'll see you in the next one.